Well, hello, everybody. This is Michael DeGioia with Dash Trader and the number one best trader competition. This is the Winner's Circle and Market Recap. Great to be here this week with everybody. As always, my co-host, Jill Malandrino, Global Markets Reporter with NASDAQ. How are you today, Jill?
I'm always good at 4:15 on a Friday.
Yep, same here. It's great to be back in the United States of America. After my worldwide travels, and it's good to be here with you on this Friday afternoon, getting ready for the weekend. Halloween coming soon, and we had a very, very interesting presidential debate last night. I'm really interested to hear your thoughts. It was a little bit more civil, slightly more presidential. I thought the moderator did excellent. What are your thoughts, Joe?
Well, the bar was really low. So,
yeah.
So just being civil isn't, I don't know if you get a gold star for that, but like we said with the last one, my concern was we didn't hear enough about policy. And to be honest with you, I had the Giants game on anyway, so I was going back and forth. But
I bet you watched the first presidential debate. And now you had the Giants game on.
I know. Either way, it was. It's been a tough year for New York sports, and the debates have been a mess too. So it was kind of like,
and the Giants lost as usual. So
well, I had Philadelphia in my pool, so I'm okay with that. But it has been a really tough year for New York sports fans. We really can't get out of our own way. But yeah, going back to the debates, it wasn't enough for me to truly understand policy. But I think what's really interesting is the way the composure of the market and how it's been digesting the debates and the election, which is just over a week from now, Mike. I feel like, I don't know if we've been talking about it so much and the markets are pricing this volatility in, but it just didn't feel as chaotic as it did after the debates and town halls a couple of weeks ago. So I don't know if the markets have priced a candidate in, and that alleviates some of the uncertainty from different basically, like Predicta is one that I use. It's basically like politics for the stock market. And they're looking at a Biden win and a blue wave. And there's some other resources that have been looking at that kind of at least show a Biden win. So I don't know if it injects some certainty in the system. We're seeing cyclical sectors react on that. I don't know if things start to normalize, if you will, if that's what the market is pricing in. I don't have an opinion either way, but the market felt very different this week. And I would imagine it's moving off stimulus headlines, fine. It's almost like 2018, 2019 would move off of China headlines. We have phase 1, 2 deal, maybe not. Stimulus is going to continue to move it. We have come to terms that it's going to be after the election at this point. So I would imagine we'll have some of the sideways action, assuming we don't get crazy headlines through the election.
Yeah, I mean, Goldman Sachs pretty much came out, I think it was 2 days ago, and they said, don't expect any stimulus deal. So regardless of what Pelosi says or what Trump says, just don't expect any stimulus deal before the election. So I think the market has pretty definitive. If Goldman Sachs has gone to out of its way to come out and say, don't expect any stimulus deal publicly, I mean, I think the market has pretty much factored in that we're not getting another stimulus deal. I mean, that's pretty much my take of things. Now,
yeah, well, think about it. Our Treasury secretaries are all ex-Goldman, so
yeah, exactly.
I think they have a pretty good read, right?
I think they have a great read, and I don't think Goldman would have came out if they thought they were going to be wrong. I mean, I think it's a safe bet that we're not going to get a stimulus deal before the election, regardless of what Pelosi says, regardless of what Trump says. So I think that from that perspective, yes, the market definitely feels different because they factored out that extra $2 trillion of stimulus that everybody's been talking about and the market's been bouncing off of. As far as the presidential election debate goes from last night, it was more civil. I thought the moderator did a great job, and I thought she was, fairly forceful. And I saw that, they actually took my recommendation of muting people's microphones, which is what I said to you. I said, they're gonna have to. Now, the fact that they had to do that is very, very disturbing because you'd expect the person that's potentially running for president to have some self-control and to be able to control their reaction. But it's kind of a disconcerting statement of reality. I think that the big bombshell of the overall debate was the whole thing with Hunter Biden and Joe Biden, and then Biden going back at Trump related to his bank account in China. which obviously was the traditional kind of mudslinging that is, kind of, what is a little bit disappointing in general for a presidential. But they did spend a little bit more time talking about issues and talking about what they plan to do. Although it wasn't very substantive, it was certainly some talk about policy, which I thought was better. In terms of earnings season, I think that, at least my read has been that the banks have been doing very, very well because of bond trading. And that has been, the earnings have been great, although for the most part, the bank share hasn't been reflected in their share price. I did see that JP Morgan kind of had a good day trading today. I have Goldman Sachs's chart up here, which certainly didn't look that great, even though they had some amazing bond trading earnings. But needless to say, I think that, what the bigger problem, and this is what I wanted to really bring up to you, is that the overall U.S. economy, I mean, real estate, retail was pretty much dead or dying going into the pandemic. And, I brought this out, I guess this was about 6 months ago, that there's about $15 trillion of commercial real estate and commercial real estate related debt. If retail dies or is dying, what happens to that $15 trillion of commercial real estate debt? And I think that part of the reason why banks aren't responding to their exceptional earnings is because even though they might have short-term bond profits, they have a tremendous amount of exposure on their balance sheet to all this commercial real estate debt. And certainly I know because, New York City has about 17% vacancies in residential, residential apartments it's basically it's coming to 20% vacancy because people don't want to pay $3,000, $5,000, $6,000 a month in rent. What happens when all of these mortgages don't get paid? And I really was very interested to hear your thoughts on what happens in this case.
Yeah, that really is a really big issue. And it kind of goes back to when we were discussing the stimulus bill, because the market is pricing in something is going to get done for sure. And that's good for the cyclical trade. It's good for the market. And we understand all of that. But the fact of the matter is the people that actually need this stimulus, it's not helping them. They are not invested in the market. They don't care about the out of tech into the industrial trade. It means nothing to them. They can't pay rent, right? That's going to impact landlords. That's going to impact the banks. And what happens when Jan 1st comes around and that moratorium with evictions runs out, right? That's when you start looking at classic long-term recession issues, right? When it starts to impact banks. If we get any sort of additional lockdowns in the Northeast, which it doesn't look promising, that's going to impact jobs. There are a number of service jobs that are not going to come back. And then when you think about it on a corporate level, as we look to 2021, how are businesses going to right size? So then you have that element in there as well. So the employment and housing issue is a big concern. I care about that more than I actually care about the market. So when you think about the market, it's a discounting mechanism and perhaps it's pricing something in, but if you're relying on stimulus checks because you have no income, I mean, how do we make people wait till January, February? I can't wrap my head around that. So these are systemic issues that are bigger than the market. The market is not the economy. I'm not sure the Trump administration understands that concept because it's constantly being compared with the market's doing well. If you can't pay your rent and you are facing eviction in January in the winter, nobody cares what the market is doing. And that disconnect is really hard to digest.
Yeah. So basically the market right now is responding to, right, whatever the government does. It's almost like a Pavlovian dog. The ring the bell and the dog salivates. The Congress talks about stimulus and the stock market goes up, and the Nancy Pelosi says we're going to get a deal. The stock market goes up. The dog salivates. My point being is that the U.S. economy has serious systemic problems. There is almost and look, I don't want to be, somebody who comes out as very negative, but I almost don't see how we can avoid a recession or a potential depression from this kind if this continues to snowball and these systemic issues are not addressed. There's $15 trillion of commercial debt and residential debt that I'm not even including in that $15 trillion that needs to be in some way rectified. The banks have made lots of paper profits. The markets have made lots of paper profits. I also believe, and I'm starting to see this now in the technology stocks, and as I go through the charts, it's starting to show some of the first signs of cracking. Obviously, people are becoming wise and aware that the current profit model for things like Facebook, although Facebook was up today, there's got to be some kind of change for Google, for Facebook, for Twitter, because these social media giants and these internet giants have now become, probably part of the problem in part of polarizing the society, et cetera. And I certainly, for me as an American, the one thing I locked onto is, whether I believe him or not, Joe Biden kept saying, I believe in the United States, I believe in America. My point being is that, as an American, we need to really face these very, very big systemic issues, whoever is in the White House, whether it's Joe Biden or Donald Trump. These big systemic problems are going to cause major economic problems going forward. And as a technical analyst, I'm starting to see that in the charts. I mean, I'm starting to see the market not care about the Congress. I mean, right now it's still responding to the Congress ringing the bell or Nancy Pelosi ringing the bell. And I think that potentially that might change soon. And it might not matter because the problems are just too big. And printing more money is not a way to get out of the problem. I mean, I think that the money printing press, the quantitative easing to infinity and beyond is certainly not the best way to solve your problems, because it just makes more problems and kicks these problems down the road, and eventually the whole system falls apart. So for me, I thought that was something that we needed to talk about. And I think it's starting to show in earnings season, because like even Netflix, I mean, Netflix was a stock that I've been saying, I don't see it going forward. And they came out, they said, oh, if we had 24 hours more, we would have beat our numbers. I mean, you can't, that doesn't, to me, that's almost like a ridiculous thing to say, that if we had 24 hours more, we would have beat our numbers. It's just like, oh, we didn't beat the clock. I mean, it's to me, I think the systemic problems are starting to show in the stock market. And eventually, technical analysis starts to catch up with fundamental analysis, meaning that if the fundamentals are bad, the technicals will be bad. Things eventually come back into alignment. I mean, at least that's been my experience, Joe. I don't know about yours.
Yeah, well, I agree with a lot of the things that you're saying. There is a lot of cans being kicked down the road here. And it's the transition from the end of 2020 to 2021, especially if we have a transition of power, there's going to be a lot of work that needs to be done. And, I think part of the issue is when it comes to earnings season, the guidance hasn't been as clear cut, because you have companies that have performed well as a result of the work from home, work from anywhere trade, technology companies. They understand that they're not going to see that kind of growth in Q1 or Q2 as a result of everyone pivoting, but there's not enough visibility to know how those comps are going to look as they get into Q1 and Q2 of next year. Because while they've had outstanding, unprecedented years, how much longer can that continue? The trend is in place, but now how do you grow on top of that? How do you continue to evolve? And I think because there's a lot of uncertainty around policy, that makes it really difficult for management teams to set forth guidance. And I just think that nobody expected a global lockdown, and they just don't know how to comp to that. And I think we'll learn a lot. And I think it's going to be really interesting when we get in Q1 and Q2 of 2021 to see how we right size, for better or for worse. But, sometimes these are the shocks to the system that you need to understand your business. Certainly, it was a good exercise in business continuity. It certainly accelerated many technology trends that were in place. So to see, it's in place now, but now how do we perfect on that experience? That's going to be what's key.
Yeah, I totally agree with you. It's about how do we adjust from here. And the one other thing that I wanted to mention was, I was just in Europe. I was I had a brief stay in London, and it seems to me like even though there were complete lockdowns in Europe, it seems like the real second wave has definitely hit Europe, and it's in some ways it seems worse than the first wave. In the UK, they were just putting in a whole nother round of regulations, I believe, in Ireland, and it was very interesting. Ireland locked down, Israel locked down for a second time. France is pretty much locked down. I think France is like 75 or 80% of the country has been locked down. They've only done local lockdowns. And in the UK, they have circuit breakers in that if it goes any higher, they will implement a 2-week lockdown. So Ireland is shut down for 6 weeks. And the interesting thing about Ireland, and this is another another topic, is Ireland was the big beneficiary of Brexit. The UK exit from the European Union, the biggest beneficiary has been Ireland, because almost 56 big banks have relocated their European Union headquarters or in the process of relocating their European Union headquarters to Dublin, another English-speaking country in the EU, unlike the UK. So either way, I think that the coronavirus continues to surge on, regardless of what your thoughts on to handle it. And I think that it's a problem that we're probably going to have to deal with going into even the first and second quarter of next year. Like, I just personally, I don't see how this will just disappear. And that's why I wanted to hear your thoughts on this.
Well, it's interesting. We covered this a lot each morning with our daily economic hit that we do with Phil McIntosh, our chief economist at NASDAQ. And one of the things that's really interesting when you look at it from a social perspective with the UK and Europe, they have a very big pub culture, which is a little bit different than what we have here. So, everybody holidays in August. The pub culture is something very different than what we have here. But how fast it's continuing to spread is pretty incredible. France, I believe, on the overnight had 45,000 new cases, the highest case count that they've had since it started. Yeah. Now, that's what we have in the U.S. We have more people living here, significantly more than they do. Yeah. So the silver lining to that is we're starting to see some progress on the treatment side of it. We understand how to, once people are in hospital, how to treat them there. We've had some time, we have some data behind our belts. This is why things can't be rushed. Traditionally vaccines take anywhere from 3 to 4 years from start to finish. And this is just showing us in real time how it happens. People were being treated with ventilators in the beginning. Now we understand to do it with steroids. They're understanding which mixture of drugs is working, what the vaccination is going to look like. And the other thing is too, it's amazing if we get an approval by the end of November, beginning of December. The issue is, and this is not rocket science, is manufacturing it at mass. You need to be able to scale it. That's where the issues, you can have all the approvals in the world, but if it's not, not everyone's going to get treated at Walter Reed like President Trump, right? Yeah, so absolutely. That's the issue too. We have to get it into the population.
Yeah, another very sad thing that I read this week was that unfortunately one of the volunteers that were taking the vaccine trials, and this is one of the risks of a vaccine in Brazil, a volunteer who took the trial of a vaccine actually passed away, which is really sad. I don't know the details of that story, but I do know that vaccines and the development of vaccines is very dangerous business for the people who are testing it. So I don't know the full story on that, but I did definitely read that one of the people who had volunteered to be in a vaccine trial did pass away. So very, very, very dicey business. So don't want to spend too much time on that. Let's jump to the charts. Okay. I'd really like to go through these, the Qqq chart. This is the NASDAQ 100. To me, as a technical analyst, a top with a rejection and a double top is very, very bearish, okay? What this means from a technical perspective, and when we talk about technical analysis, we always talk about the people and what are the traders and the investors doing that goes into this chart. So when I look at this chart, it says, okay, the market sold off on the pandemic. Everybody invested in technology. Technology is the way of the future. It broke out above the pre-pandemic high. The digital trend is definitely, the analog to digital trend is in effect. It exceeded and rapidly increased, the movement to digital. Like, for instance, a great example of that is every time I go into a restaurant, you have that little digital square that you scan with your phone. Like, I've seen that thing for like 5 years and never used it until the coronavirus pandemic. I don't even know what that thing's called. QRC code, I think it is a QRC code that you scan with your phone, and then it's the menu. But needless to say, like that thing, nobody ever used it until the pandemic. But now, so the market runs up, it kind of rejected the high, but nobody waited for it to make a double top, and it didn't make a new high. It rejected after it made a lower high, meaning everybody's expecting a sell-off. So when you have a high, the market ran up, it pulled back. Instead of making a new high or a higher high, okay, it made a lower high, and it rejected the lower high before it got to 300, before it got to the previous high. So it's not even a double top, it's a lower high. So that means that people are very, very cautious, very nervous about this. The volume has picked up, and it's irregular volume. The only thing I would say on the weekly is that obviously we've only had 2 weeks down. Last time we've had the most we've ever had in this entire run-up is 3 weeks down. And we're still above the moving averages on the weekly. On the daily, we've had 1, 2, 3, 4, 5, 6, 7, 8, 9 down days, but on fairly low volume. Okay. However, if we cross under those moving averages, this becomes exceedingly bearish. Okay. Meaning that we made a high, we made a lower high, and now we've gone under the moving averages. I mean, that's almost like confirmation of a potential sell-off if we get under those moving averages. Now, obviously, we can rally from here, and hopefully we do next week, but we certainly have a tremendous amount of uncertainty going into next week with the election. And, the one thing I noticed about options pricing is that the options prices for puts are very expensive, not just for next week, but they're going past the election. So the options pricing, meaning that people are not just scared up to the election, which is what traditionally happens in an election year, they're buying puts on November 20th. Okay, there's November 20th puts are more expensive than they should be because people are worried about a contested election. And for me, I've been trading since 1998, 1999, and I've been watching options pricing. And I know that usually you expect an increase in premium because of volatility going into the election. But probably the only other time I've seen this is in the last 2 elections, but never to the extent that we're getting in this election where the options premium is as fat as it is, because people are seriously concerned that the election is going to be contested in some way. And, after watching the presidential debates, that doesn't surprise me. The SPY, the spiders, is also a lower high. And now they're actually showing relative strength. The spiders and the diamonds are showing relative strength to the NASDAQ. Obviously, the NASDAQ has run, the QQQ has run a great deal further. So here on the SPY, we have the same kind of weekly pattern. We made a high, a failure to make a new high, failure to make a new high. Today, we put in a red bar, which could potentially be another lower high. So it'd be 1 lower high, 2 lower highs, 3 lower highs. If we break below the moving averages, that's almost like I said, it's exceedingly bearish. And I don't want to be all negativity here, but I think people are really nervous about this election, and traders are certainly nervous about this election. On the diamonds, we never made a new high pre-pandemic. Obviously, this is still the weak man, although it is showing some relative strength now. It's holding up fairly well, as I believe we're getting some cyclical change as people are taking money out of technology. They're moving it into things potentially like Coca-Cola, things that are a little bit more consumer cyclical, although there's a lot of indication that even consumer cyclicals are starting to get some selling pressure. But needless to say, you got a high, a lower high. that same triple reject kind of pattern. We are still above our moving averages, so we still have to say that the market is neutral. We are not above all of our moving averages. We're above our long-term moving averages and just below our short-term moving average. So short-term moving average is this bluish one. That's the 20-period moving average, the 10-period moving average, but we are still above our 20 and our 50. Same goes for the S&P and on the NASDAQ. So we're literally all tangled in our moving averages on the borderline of going very negative after a high and a rejection of the prior high on both the daily and on the weekly. Excuse me one second. I'm sorry about the phone.
Well, Mike, as you are working through that phone call, I just want to point something out as we're talking about SPY and QQQ. I just want to interject real quick. So,
sure, go right ahead.
And we're also in the thick of the earnings season, which is so crazy because we've been so focused on the election, so focused on COVID-19. Meanwhile, we're like in the thick of earnings season and it's been a blip on the radar. But I think it's important to point out for traders that Thursday, October 29th, after the close, Amazon, Apple, Facebook, Alphabet, Twitter are all reporting like within 30 minutes of each other. So it's going to be an incredibly busy time. This is 15% in the S&P 500, 35% in the NASDAQ 100. And I just think it's important to be aware of that day because these have been so instrumental in strength in 2019, let us out of COVID-19 shutdowns, and have really been leading the way for the entire year in 2020. And I think it's going to be important to hear what they have to say. Some of them even have some regulatory headwinds to face as well. But, those are 5 key stocks. And I just think if you have a tech heavy portfolio, if you trade around the NDX or the Qs, even the SPY because of the components and the weighting that they have in there, it's just something to be aware of.
I also need to point out that never since the internet tech bubble of 2000 has the market's been so tech heavy. It's basically, this is the most tech market that we've had since 2000, right before the.
It makes sense though, right?
Yep.
This energy and financials used to have the weighting and the juice behind it in the major averages, right? This is the modern day industrials. It's a new economy. It's different. There's so many comparisons to 1999, but I think the companies that are leading the way now are very, very different than what they were in 99.
Absolutely, they're profitable.
But they're legitimately a part of the economy. So I think we need to look at it objectively.
I totally agree with that. And I actually have a number of those companies and their charts up here to look at. Mm-hmm. So we have gold, okay, which on the weekly looks like it's forming a potential bull pennant, which it's been forming for some time. And I mean, generally speaking, a pennant will usually break out in the direction of the previous move. So if the prior move was up, a consolidation, it breaks out in the direction of the prior move. Now, obviously, with all the uncertainty, gold is a hedge to the U.S. dollar. It's considered a traditional U.S. dollar hedge, especially with the expectation for interest rates to stay low for a long period of time. So obviously, gold is doing what it should do. Although it has pulled back quite a bit, it does look like it's getting ready for a breakout and another move to the upside. At least technically, the moving averages are indicating that. The only thing negative about it is that this pennant has gotten a little bit long in the tooth, meaning that the pennant has been forming and not breaking out as quickly as it should. And that brings me to the next chart, which is I use the GBTC, which it's not Bitcoin exactly, but it's a Bitcoin tracking stock. And I think it's fairly tracks Bitcoin fairly well. And it seems to be doing, to me, this is like we would call this a rounded bottom. It's kind of forming a cup formation where, it's made a low, a lower low, a deep low, and then it's made a higher low and another higher low. It's rallied up to its prior high. It has one high that's a little bit higher. That would be, taking it up to 17. But basically, it's forming like a cup, which usually means accumulation before another move to the upside. And now Bitcoin has certainly become the alternative store in value. So you have traditional gold, which is the traditional US dollar hedge. And now Bitcoin's kind of been the alternative US dollar hedge. And I believe that the other thing that kind of spurred this move on is that, a company like PayPal with, I think PayPal has 26 million users. PayPal came out and said, now you're going to be able to buy Bitcoin in your PayPal wallet, right?
Right.
Which
Yeah.
is going to add demand to Bitcoin, right?
It definitely is. And I would say the past few weeks have been really encouraging for mass adoption of cryptocurrency in general. You had the $50 million investment with Square, and then the PayPal announcement is huge. That brings on nearly 330 million users to the platform with the introduction of Bitcoin. That's virtually the population of the United States. So it's been a really interesting move for crypto. I think with the rise in decentralized finance, more commonly known as DeFi, it's been a fantastic year for Ether. In fact, Ether is a top performing asset when you look at the crypto universe, in fact, outperforming the NASDAQ 100 because people are employing these technologies for these different kinds of platforms, and which makes it so interesting and unique when you look at cryptocurrency and the technology that's being developed. When you are on an app, each app kind of owns your data, like you're locked in that ecosystem.
Yeah.
With this kind of technology, you can go from app to app and it's only you. So there's a lot that's going to be done there. I had someone on today from Grayscale, which is very well known in the asset management side on the cryptocurrency business on my show this afternoon. And they had about $2 billion under management in February. They're up to just over $7 billion as of yesterday. Tremendous growth.
Yeah, and that GBTC is Grayscale Bitcoin Trust. That's exactly who you had on your show today.
Mm-hmm. Yep.
So just to give a little bit of explanation of that, it's called owning your private key. So if you own your wallet and your wallet is a real cryptocurrency wallet, you own your private key, which controls your cryptocurrency. So you can literally lend it out and do all kinds of things through DeFi and various different DeFi arrangements. And you can be lending and borrowing and doing all kinds of things while actually owning your private key. And that's all been pretty much built on the Ethereum platform. Most of the Ethereum won the DeFi wars. There are a number of different operating systems, and certainly that is a disruptive technology to the banks, which may be one of the reasons why when I bring up one of the bank charts, the banks aren't performing so well, because anybody who is in banking knows that they have a very disruptive technology here looming in the wings. And certainly companies like Goldman Sachs are investing in crypto, and JP Morgan have already invested in crypto, and people are starting to adopt it. Now, PayPal certainly did not PayPal ran up into that announcement. They kind of made an all-time high, but in the last 2 days, PayPal's kind of simmered down after that big move up. Additionally, Apple, the chart on Apple has crossed below its moving averages. And, one of the things that I've always watched during this entire run is Apple. Apple has been the leader of this entire tech rally. And now Apple is starting to look like it's losing a little bit of its glimmer. And you can see Apple put in a high, a lower high, and now it's crossed below its moving averages. So certainly Apple has kind of lost some of its strength, lost some of its glimmer. And I don't know if that's going to continue, but certainly we're going to be watching Apple closely because it has been the leader and a great indicator of technology as a whole. Any thoughts on that? To me, I take that as very negative, the fact that Apple's crossed under its moving average. It needs to stay under it. And certainly we got to see how they do. But for the most part, for me, that's a big thing, is to watch the leaders.
Yeah, I would agree with you there. And again, we'll get more visibility after the earnings reports on October 29th. But I think product and replacement cycle is really going to be key with these companies, and seeing how, they're shifting into enterprise and locking consumers into their ecosystem, right? So even think about it with Apple. I can't imagine moving to another ecosystem. My entire house is tied to it. Our laptops, our tablets, our phone, our TV. Like, I just can't imagine breaking out of that ecosystem. And Apple's done a fine job of doing that. They've been the leaders in doing that.
Yeah, I'm a little bit of a technophile, so I have an Apple and an Android just to keep myself apace of things. But I certainly favor my Apple over the Android operating system. But I totally understand what you're saying. But the one thing is that Apple is facing a ton of competition. they are losing market share. And that's something that they are really trying to kind of get into other areas, because they are losing market share in the actual cell phone market and the smartphone market. Facebook. I thought Facebook would certainly not be doing well. It certainly looked like Facebook was about to turn to the downside, and then they gapped up and started to break away as of today. Again, Facebook continues to amaze. But I want to see if that continues. Certainly the 29th will shed some light on things. But certainly Facebook continues to have what I would look at as a bullish chart. It's put in lower highs, right? It's got a lower high, but it's got higher lows, and now it's above its moving averages, and it's possibly breaking away into the run into its earnings. I don't know if that's just an earnings run or what. Certainly we saw an earnings run with Netflix that after the earnings, it looks like Netflix might be turning to the downside. Netflix to me put in a triple top, it dropped, and now it's below its moving averages, and it looks like it's turning the corner. So from me, I see two of the three tech giants, having some negative, having negative technical patterns. So that was just something that I noticed. And Netflix was interesting because they also cut out a lot of popular shows. It seems like Netflix doesn't like any show after the third season. They just cancel them. Microsoft put in a high, a lower high, but it's still above its moving averages. Google still running, even though they might be facing all kinds of regulations. Google still seems to look like it's doing great, even though it's got a lot of questions on the horizon. So we'll see how that plays out as well. Coca-Cola had some really good earnings. I believe that Coca-Cola, I think is benefiting from some of the uncertainty as a defensive stock. So I put Coca-Cola up here for us to look at. It's got kind of a wedge forming or a pennant forming. So certainly above its moving averages. It's kind of near its highs. It's considered a defensive company. Probably not the most exciting company in the world for you to trade, but certainly a company that has a lot of defensive elements. Goldman Sachs had amazing earnings, but you wouldn't see it from the chart. The chart seems to be flat, and I think that's possibly because of all that kind of DeFi talk. And that brings us to our winners from our number one best trader competition. So we have our third place number one best trader competition. We have Edgar, who was trading under best 470. So Edgar is from Lima, Peru. We have a very big following out there in Peru. He is an administration and finance manager. He holds a master's of business administration, and he graduated with an accounting and finance background. His experience, he has 6 months of trading experience in the stock market. He usually likes to make investments to the medium to long-term time frame. He's part of the global Bolsa group trading community in Peru. We've had many winners from the global Bolsa group. And we actually, I had the benefit of meeting Roberto, who came, who I think is one of the first winners of the number one best trader competition. So it's great to have Edgar as one of our winners. His strategy is as follows. Basically, he uses technical analysis to study stock cycles, which is very well known as Dow theory. He also traded stocks that were in the cycle, but he also tried to look for some value stocks as well. Anything that was, he was looking for about a 15% value or 15% move from the previous week. Mistakes, he said that at times he was impatient. I think we all get impatient sometimes, impatient to trade. And at other times he was trading against the market, meaning he was trying to find things that were going short when the market's going up or vice versa. He learned a lot in the number one best trader competition. Okay, and he knows that it requires you to take control of your emotions, since you have to deal with your emotions every single day. Now he understands that he should only let himself be carried away by the markets and not get and try to trade against the market. So you always want to trade with the markets and not against it. So a big congratulations to Edgar. Now it takes us on to our second place winner. Our second place winner is David. He was trading under best 964. Okay. Originally, David is from Dublin, Ireland. We were just talking about Dublin, Ireland, as they just had their lockdowns. And certainly now they're benefiting from all the Brexit. After the UK left Brexit, a lot of banks are moving to Dublin, Ireland. But David moved to Philadelphia, Pennsylvania, and he's a real estate sales professional and an equity trader. His experience is he spent the last 3 years trading both on sim and in live modes. His preparation, he looks at his trading journal, he reviews his trades each day. He also likes to periodically reference a complete guide to volume price analysis by Anna Culling. Reading her book has been instrumental to his progress as a trader. He also enjoys Trading in the Zone by Mark Douglas. It's a book that I've read myself. It's a great book. Also, he has The Disciplined Trader as well. It was another one of his books by Mark Douglas. He's a member of the BBT, Bull Bear Trading Community. His strategies, he looked for 1 and 5 minute ORBs and kept track of his stocks. Certainly stocks that were looking to make a lot of moves on volumes and making parabolic moves. It's either parabolic move up or parabolic move down, and that he could potentially trade on the 5-minute chart. He also had a personal strategy that he calls the crucifix because of the way that it looks on the charts. And when he looks to that, on the way that it looks to, he tries to execute that from 9:45 to 10:45, which is a major reversal time. His main strategy is to trade the parabolic SAR technical indicator on his charts. Lastly, he kept a very close eye on volume. That's not surprising considering the book that he read, which is A Complete Guide to Volume and Price Analysis. So certainly he keeps a close eye on volume. And on the pre and post market charts and pre and post market levels. Good thing Dash Trader has pre and post market charting capabilities, and he watches his level 2 for order flow for all of his trades. So he's watching to see where the prints are going off on his level 2. His mistake, he over traded at times. I think we've all over traded at times. We think we're traders. It's our job to trade. So sometimes we forget that not taking a trade is also our job. So sometimes he racked up lots of commissions and ECN fees that would have otherwise turned a profitable day, and he turned it upside down. He also traded a few low float stocks, and despite being largely successful, he would normally touch these stocks. He would never normally touch these stocks in his live account because of their volatility, but because it was a paper account and sim trading, and the number one best trader competition, he took shots at them. And that's a good thing to learn. It's better to focus on the stocks that you would normally trade in your live account and trade exactly as you would in your live account, whether it's sim money or real money. He learned to be successful in the competition, it's important to focus on your own trading style and not spending time on what other people are doing or how well or poorly your trades are doing. You just got to focus on trading your strategy. It's critical to keep an eye on and try to keep yourself from revenge trading and try to keep your revenge trading to a minimum. We all get emotional. We all want to take back our gains. So keep your losses small and live to trade another day. So great advice from our second place winner, David. We are still waiting for our first place winner to respond. So certainly next week we'll get you who our first place winner is. But a big congratulations to both David and Edgar, who did a great job in becoming third and second place in the number one best trader competition. So congratulations to our winner. Stay tuned in the future for our next number one best trader competitions. Certainly, you should follow us at number one best trader on Twitter, Facebook, and Instagram. And we certainly hope you're already following us on our Dash Trader Pro channel on YouTube, as well as the Gas Trader on LinkedIn, Twitter, Facebook, and Instagram. And I want to thank everybody for being here with us. It was a great show. Look forward to seeing you all next week. Have a great weekend. Trade well, everybody.